Okay, so good morning. After having solved these minor technical problems, let me first thank you, Julio, and thank you, Mark, for this invitation here. It has given me the opportunity to know this beautiful city of Arequipa. I'm meeting again with a few friends from my central banking past. The topic, and this morning, at least in this session, I think is quite challenging. It raises key questions around the monetary policy transmission and by implication of financial stability. I would say one of the topics deals with the short-term uncertainty, which has to do with current monetary policy and the issue of negative rates. And the second one raises uncertainties in the medium to long term, but is getting closer and closer, which is associated to technological changes and basically with finance going digital. So let me go through both of them. So first, the monetary policy and negative rates. Well, the issue of negative rates is quite novel in the domain of monetary policy. Since 2007-2008, the task of sustaining growth and preserving financial stability has fallen for the most part on the shoulders of central banks. Central banks have become really non-conventional, trying all kinds of instruments tailored to the financial system that is transmitting monetary policy to the economy. And in so doing, most of them have gone through the avenue of exhausting the leeway to reduce rates, then enlarging the size of the balance sheet of the banks in different ways. In most countries, governments went into the markets buying securities in large amounts. In the case of the European Central Bank, the first approach to this balance sheet enlargement was through the avenue of increasing the size of the refinancing operations to the banks. Remember that in Europe, the financial system is made up in 75–80% by banks, so sustaining banks and keeping them alive was a priority. But when this was exhausted, also the ECB went through the avenue of buying assets, first in an initial phase, not pretending to enlarge the balance sheet, but repairing the money transmission mechanism by trying to deter speculation, in particular against the sovereign of countries in a weak situation. But lately, since the middle of or since the beginning of 2015, since March, also buying assets in large amounts is conventional QE, buying both public and private papers. So this has been combined in the case of many central banks with trying to break the zero lower bound, so it's not zero anymore. Now the question is, what is the name we give to the lower bound of monetary policy? Because central banks, clever as they are, as Governor Jensen said just a minute ago, found ways to bring policy rates below zero, using in many cases the deposit facility rates, which is the standard, or is the reference rate when there is excess liquidity and when the banks have to deposit excess money in the central banks. Well, is this policy having an impact? You see there a number of central banks mentioned, used negative rates with different purposes. In some cases, like in Denmark and Switzerland, there is an explicit purpose of discouraging capital inflows. In other cases, it is about fighting the tendency towards deflation. In some cases, there are both objectives in the mind of policymakers. But the question is whether this has been effective. And there is now an ongoing discussion on whether the effectiveness of these policies is granted or not. Just focusing on the European monetary union, one can say that the QE combined with negative rates has functioned, but maybe getting closer to the point of where benefits and costs are closely aligned. See, since 2011, the rates of funds for most companies and individuals have fallen in between 1.7 and 2%, but still, according to the data published today and a few days ago on lending, you see lending growing at rates which are lackluster, I would say around 1.5% or so, which is not a brilliant rate of growth given the excess liquidity you have in the system and the amount of measures taken in order to promote credit or funding to the real economy. If one looks further into the issue, this policy has impacted into long maturities in the yield curve. You can see there Switzerland comparing May 2015, so 1 year ago, to situation today. From negative rates at the 9 years maturity, they have gone into negative rates in the 30-year maturity. 30 years. So you want to invest 30 years and you get negative remuneration if you buy Swiss securities. And this has been the pattern, not so acute, not so extreme, in other central banks, including Germany, from 4 years maturity in the negatives into the 15 years maturity. The same applies to Japan and so on. So this has impacted the yield curve, and some central bankers have made remarks of some discomfort with this situation. Is so unconventional that it raises doubts to whether this is what we want or not. And also from academia you start to hear some remarks in the same vein, like Blanchard, for instance, and he is in a way backing policies that would not go further into this avenue, but extending QE programs and possibly other measures. And why is that? Well, possibly because there is an increasing realization that there are some unintended consequences, real or potential, that could block the monetary transmission mechanism. So with the intention of promoting lending and smooth financing to the economy, maybe these measures combined are having the potentially serious unintended consequences that block transmission of monetary policy. And why is that? In spite of the fact that, as was shown before, some banks, not all, have been able to maintain profits, this has been done in ways that are, at least this is the view of some, temporary, doing some corporate and investment banking operations, doing some deleveraging, raising fees where you can raise the fees. In most cases you cannot. So, and this is translating into fewer incentives to maturity transformation, which is the real role of the banks. We have many operators in the markets buying and selling, but what the banks do, to the difference of others, is taking deposits and lending. And if this is the measure of effectiveness, there are reasons to doubt about this. And why is that? Usually rates on active operations go down quicker as a reaction to monetary policy, but rates on deposits go much lower, and in many cases they hit an implicit lower bound because many depositors don't accept negative rates, so they prefer either to withdraw the cash or to go to alternative investments, which is impacting in the cost of funding to the banks. Negative rates also raise operational issues that have been solved in some areas, but it looks like, according to remarks made by Mario Draghi in press conferences, that this has some operational complexities, at least in the euro area, and also it could carry signaling implications, because if you go that avenue, you are signaling that you are willing to go even further down into the negatives. So these are the reasons why it seems that the ECB doesn't go into too tired or multi-tiered deposit facilities with different rates. Of course, this is impacting, by and large, and taking into account the the overall accounts of the financial system in the Eurozone is carrying an impact on profits, at least on regular profits. Once you take out special operations, it would have implications in terms of financial stability associated to currency wars, but also associated to potential price bubbles. And of course, we have now the instruments to fight them better than we had in the past. But the issue of how to identify in real-time bubbles remains a challenge for central bankers. So there are a lot of potential unintended consequences, including those affecting savings and deposits. As I said before, it is in a way difficult to go negative with deposit remuneration, but this has also implications in terms of political impact. And if you read German newspapers these days, you can know what I'm talking about. People making a lot of pressure, putting a lot of pressure on the central bank and on the politicians to blame the central bank for expropriating their savings. So this could have also political consequences. If we focus more specifically on the side of the banks, of course, the measures taken, including negative rates, in theory, have the positive effects that you have on the left-hand side. So first, negative rates should create higher credit demand. This is the traditional interest rate channel. Second, it lowers the funding costs of the banks, in principle facilitating the bank lending channel, and also inducing better quality of credit, and this is the traditional balance sheet channel. So in theory, everything is okay. But when you go to reality, you find that lower profitability of the credit activity of the banks, not profits, lending activity is being reduced, and this has a dynamic impact on solvency going forward, which means that there are less incentives to go into this kind of activity. And if you combine it with additional regulations on banking activity, the attraction for the banks to lend is less. So in a way, you have some blockage to the bank lending channel, because the supply of lending doesn't increase automatically. You have more liquidity risk to the extent that depositors have an incentive to withdraw deposits, either to hoard money or to invest in alternative investments, say investment funds. And finally, of course, the client solvency in terms of debt burden. Low rates create no incentives to reduce the debt, on the contrary, and this could have an impact on client solvency. So this is why you hear some complaints coming from the banking sector, and frequently also from policymakers, that these may have gone to the point of a break-even, where the benefits are more or less compensating or aligning themselves with the cost. Are there hopes to change this situation pretty soon, to have interest rates going into the positive, into the black? And unfortunately, the answer is no, because it looks like we are living now in a world with very low rates determined by real factors, including demography, aging populations, basically the unwinding of the baby boom generation is with us, and this creates an incentive to increase savings. And also, as life expectancy increases, the incentives to save, given the situation of public pension systems, will be with us, so excess savings will be there. And also, capital expenditures are less than we were used to see, due to many things, including the reduction of the relative price of capital goods, and also uncertainties about the future of all kinds. Technical uncertainties, more pessimism on the side of investors, you call it. But the fact is that we have way too much savings for the investment that we see, and this implies, of course, very low rates or even negative rates in order to make expected or planned savings equal to investment. And this is associated to the theory of secular stagnation that will be the subject of a different panel today. So if natural rates tend to be around zero or negative. The hope that we will see central banks unwinding the policies that they have put in place are not really very high. So the questions, of course, are there. They were raised before, some of them, and maybe can trigger some debate. Is there a floor to the effective lower bound of interest rates? The nominal bound is zero, of course, but the effective we have seen that can go well below that. For how long? My conjecture is that we will see very low rates for very long, and this raises a lot of challenges. Would negative rates become a permanent part of the monetary policy toolkit? We need to start thinking about what the world for central banking looks if negative rates is more or less a permanent feature of the environment. And finally, to what extent negative rates are could be, or the impact, the side impact of negative rates, and sorry because it's so, you cannot read below, negative rates could have potentially negative effects on financial stability that might perhaps be counterbalanced by macro-prudential policies. And we have additional tools, fortunately, to fight with that. But now let's move to the second issue, which is creating challenges, I said medium to long term, but maybe those are closer to us than we think, which are those associated to technology. And payments, of course, is part of the story, but the story is much more complex, to the extent that one could say that the banking system, and this is particularly relevant for Europe, where the financial sector is based on the banks, the banking system is going through, one could say, a perfect storm because the forces at play coincide at the same moment, making the banking activity much more challenging and difficult than it was in the past. So it is my personal view that banking as we know it will never come back. So there is no hope that after this crisis we will see again banks thriving as we saw them before. And I will try to convince you of that. First of all, you see the situation of low returns and low profitability of the banks created by many forces, including, of course, monetary policy, but low growth and a damaged balance sheet, is opening up opportunities to other challengers to come into the system. Banks don't have an incentive to lend, but there are others, P2P and others, willing to lend and to find a profitable opportunity without the banks. Recession has created damage in the balance sheet of the banks, and banks are therefore less prone or more reluctant to supply credit to individuals and involve themselves in other activities. Reputation, as was said before by Governor Velarde, is an issue. There is an international survey putting the banks only slightly above the tobacco industries in terms of the reputation they have in the population, not to speak about the youngsters and the millennials. And this creates an issue because the banking industry lives out of confidence and reputation. If you don't have the confidence and the reputation, other challengers have an advantage ex ante. If Apple would open tomorrow a bank, the Apple Bank, it would have millions of clients on the first second. People moving their accounts immediately to Apple or Google or any other technological company having good reputation for providing service. Regulation, for good reasons, is creating problems in the banking industry, not because the regulation is not justified, which is, but in terms of what the market is asking for the banks to do, which is front-loading all the regulation, coming at the same time, and also with a lot of uncertainties going forward. We are talking about Basel IV, and I know that central bankers don't like this, but this is indeed Basel IV in terms of the implications it will have on capital demands on the banks. And finally, of course, the central pact that I skipped, revolution. It is the digital revolution in banking, which is made up by a number of innovations, but the central thing is that the client of the banks is changing. It's not the same. The client of the bank now is hyper-connected, increasingly millennial, thanks to mobile technologies and the massive use of data, so that the technology of approaching clients via the branches is not anymore the fashionable technique. On the contrary, clients now are more empowered than ever before, they can compare all kinds of alternatives to make reality their projects, and they have at their disposal enabling technologies. There are innovative infrastructures associated to digital and new business models that make this possible. You see, in terms of digital enablers, it can be used now in finance that was not used before. Of course, you have artificial intelligence, the hyperabundance of data, thanks to the Internet of Things, among others. Of course, enablers associated to cybersecurity, because it's key to be able to identify people and protect the cyberspace. And there are improvements in this. Data processing capacities are huge, are many multiples of what we were used to see. In terms of digital infrastructures, I would mention only two. Cloud computing is one, which makes operations scalable almost without limits. And secondly, blockchain, that was mentioned before. And blockchain could be the real disruptive infrastructure going forward. And of course, new digital models associated to this P2P, B2B, B2P, B2C, without banks in the middle. That's the key. New business models associated to these technologies. Is this going to unwind? Is it going to go back? I think it's quite unrealistic that even with the protection of regulators and supervisors, this can be stopped. And this is why I'm convinced that the situation that we live now has no way back, that the future for the banks is going to be very difficult. So banks would have to reinvent themselves or disappear or adopt a very passive role as platforms on which agents that do payments or agents that provide services operate. So the banks would lose the contact with the clients, and this means the end of banking as we know it. They would become more like telecoms, offering the infrastructure on which others would operate. And this has potential implications for, of course, banks, supervisors, and regulators, as you can imagine. Concentrating to blockchain that was mentioned before, this graph comes from a report completed by Euroclear and Oliver Wyman, kind of stating the speed at which it is now likely to blockchain to become a mainstream technology. At the moment, you have some investments, some banks cooperating in consortia, trying to find standards in order to use the blockchain technology. As you know, this technology can be used in issuing securities and trading with them, verifying identity, doing cross-border payments, conducting trade operations, instant settlement, easier collateral management, monitoring OTC, derivative operations. Clearing houses in this context might not be needed at all, so they perhaps have to close down. More globalization, more effective supervision is a potentially upside. And you see there that it looks like in 5 years' time, according to this report, we could have thin applications gaining in the industry-wide traction, and in 10 years, this technology becoming really disruptive. If you combine this with cloud computing, you can imagine what the ecosystem of finance would be. So what are the, and as regards new business models, I mentioned those before. There are many interesting business models out there. The most relevant and the most well-known is P2P, P2P lending, and you have many companies doing that, Lending Circle, Funding Club, SOPA, many others, that basically what they do is identify those in need for lending or for loans, and investors on the other side, they are just intermediaries, and in principle they don't use the banks. They identify investors willing to make a return, and lenders that have not been able to obtain finance from the banking system at a satisfactory price. This business model is already today obtaining 1% of the banking revenues coming from consumers. But the expectation is that in 2020 they will be doing 10% of the banking revenues coming from consumers. So it's a challenge that is gaining traction very, very quickly. Initially, these initiatives had some, including nice emotional attraction. They finance good initiatives, crowdfunding. You have a nice social project, the banks are not lending you, you announce it in the internet, you have the money coming. So it's cool to use P2P. Over time, we have now known of some scandals associated in this case to Lending Club in particular, but I think it was not fair to refer to this name. But what is the problem here? That in some cases, the funds of willing investors are lacking, so that these companies have started to do things that we are familiar with. Securitized loans without proper standards and selling them, so losing the incentives to monitor risk. They are using very model nobles with correlations that have not been tested throughout the cycle, so they might identify risks that are not ideal risk to invest in. Investor protection is not at the highest, so there are many investors that put money in that thinking that this is quasi-deposit, which is not, obviously, and you could lose all the capital. The risk is 100% of the money you put, and so on. So, but taking aside these challenges, there are many attractive business models out there that could, of course, succeed going forward. What are the critical areas for supervisors and central bankers in this domain? It's clear that for those banks that would like to compete with these new initiatives, there should be a level playing field, so that not for the sake of being named or labeled a bank, you should face tougher conditions. Consumer protection, because keeping confidence of consumers is key here under the new models. And indeed, through KYC, for instance, or AML, is not as strict these days as with the banks. And of course, it would be great that supervisors and regulators would be proactive, trying to promote these digital value propositions, also preserving financial stability and security. So the scenario for the future of finance, and this is of course a personal take, after some reflection, is that either we see in the future banks evolving towards an infrastructure mode, so becoming more like utilities on which all the newcomers operate, including the APIs that do payments, aggregators, instant payment companies, and so on. This is not a brilliant future for banking, to be very frank. Nothing to do with what we see today, losing all contact with end clients. Or the alternative, there would be probably going forward less banks, because concentration is clearly needed in the sector. There is a huge overcapacity, and those banks surviving, becoming more like technological companies than closer to what they are today, meaning investing a lot in technology, investing a lot in preserving the main asset they have, which is knowledge of the client, and combining this knowledge with the data that is out there in the internet in order to provide good experience and good reputation. But for that scenario to be possible, of course, there is a lot to be done on the side of regulation and supervision. So my last slide, and sorry for the extension of this presentation, is just making a summing up of what can be seen as relevant in terms of financial and monetary stability. Only a few governors or a few central bankers have started to write and reflect about the implications of this landscape in terms of monetary policy and financial stability. And I think there is a great deal of urgency in developing a mental framework. What does it mean in terms of the bank lending channel of a world where banks are less and less and less and less relevant? What is the world of macro-potential policy if most of the macro-potential instruments are designed in terms of banking variables? So loan-to-value, loan-to-deposit, and so on. If banks are less and less relevant, maybe you have to think of other policy instruments to impact the rest of the financial system. What is the role of the wealth channel of monetary policy? Possibly more. because in that context where you are risking the full capital when you go through P2P lending, this wealth channel, I think, is more relevant than is in a world made up by banks. But indeed, there are many, many reflections that have to be done. Mark Carney has started with those reflections. I think there is a speech out there a few days ago trying to outline the main challenges, not the solutions, but at least he has a list of question marks for central bankers, and this, of course, fills one with optimism about this. What is clear, I think, is that it is more necessary than ever today to see some level of cooperation between the private sector and the public authorities in order to sail as smoothly as we can towards the world of digitalization. And this means probably sandboxes for new technologies to provide finance, to understand that if you protect too much the banks, in the end you kill them, because you eliminate all the incentives they have to innovate quickly. So there is this paradox that many banks feel secure and protected behind the regulation because they know that Apple or Google don't want to be regulated like banks, but in the end they will not innovate to the extent needed in order to compete with fintechs and with the huge technological companies. Also with blockchain, there are many policymakers which look at blockchain with a lot of optimism and good feelings, like Mark Carney himself or Greg Metcalfe, the chairman of IOSCO, and so on. There are many, many things that could improve if you use properly blockchain, including supervising, if you become a node in a permissioned blockchain. But indeed, thinking about this is a precondition to help in this transition towards a safer and smoother finance. Thank you very much again for the invitation.
Thank you, José Manuel. We have time for some questions.